Have you ever, looked at a $3 carton of eggs, swiped your loyalty card to get 50 cents off, and realized that you aren't actually the customer in that transaction?
Oh, yeah, because you're the product.
Right. It is a jarring realization.
It really is. The physical items you put in your cart, the eggs, the milk, the bread, they are increasingly just the bait.
Yeah, the modern supermarket is just this unbelievably complex financial machine. And it's basically masquerading as a community grocery store.
Exactly.
And that is exactly what we are unpacking in our deep dive today. We've got our hands on Kroger's freshly released Q1 2026 earnings report.
Hot off the presses.
Right, dated June 18th, 2026. And our mission for you listening is to use this huge stack of financial statements, balance sheets, and management commentary to dissect the anatomy of a grocery giant.
We really want to figure out the underlying mechanics here.
Yeah. How does a business generate over $46 billion in a single 3-month window? I mean, to do that, we have to look way beyond the physical shelves.
Way beyond.
We are venturing into their digital ad networks, the pharmacy counters, and the really high-stakes mathematical game of retail margins.
And the stakes here really cannot be overstated. I mean, in the retail sector, margins are famously razor thin.
Right. It's not like tech.
No, not at all. We are not talking about tech company markups. We are talking about fractions of a single penny on the dollar making the difference between a record-breaking quarter and, well, complete disaster.
Wow.
So when a massive entity like Kroger alters its supply chain or tweaks its digital app or changes the price of generic medication, it sends a ripple effect through the entire economy, and it directly impacts their survival.
Okay, let's unpack this, because before we can really understand the weird kind of futuristic ways Kroger is evolving, we have to establish the baseline of what just happened in this first quarter.
Right, the top-line numbers.
Yeah, and looking at those, it is a fascinating balancing act. Total company sales hit $46.1 billion for Q1 2026.
Which is up from $45.1 billion in the same quarter last year.
Yeah, a billion-dollar jump sounds fantastic, but then you look at identical sales. And for anyone who doesn't track retail, that's basically just a metric measuring sales at stores that have been open for at least 5 full quarters.
Right. And it excludes gasoline.
Exactly. And that number, that identical sales number, only grew by 1.0%.
Yeah, and even that 1% growth requires some context,
Yes.
Buried in the management commentary, they note that this identical sales figure faced a 130 basis point headwind.
Wait, a headwind from what?
Directly from the Inflation Reduction Act.
Really?
Yeah. Now, whenever we encounter basis points in financial speak, 100 basis points equals 1%.
Okay, so they lost roughly 1.3% of potential growth due to macroeconomic policy.
Exactly. The Inflation Reduction Act altered Medicare Part D, which changed how pharmacies are reimbursed for certain drugs.
Oh, wow. I wouldn't have thought of that.
Right, but when you are dealing with volumes as massive as Kroger's, a policy shift in Washington translates into a massive, immediate revenue pressure right at your local pharmacy counter.
So they are fighting these massive external headwinds. Yet their GAAP operating profit, the raw profit from their core operations, still reached $1.4 billion.
It's incredible.
And their adjusted earnings per share, their EPS, hit $1.58. That is a 6% growth year over year.
So they are making more profit per share.
Right. But here is the mechanism that made me stop reading and just, scratch my head. Their gross margin actually decreased.
Down from last year, yeah.
Yeah, it went from 23.0% last year down to 22.7% this quarter.
And the report blames higher transportation costs, egg deflation, and what they call planned price investments.
Hold on. Planned price investments. I mean, that just sounds like fancy corporate PR spin for, Target and Walmart lowered their prices so we had to panic drop ours so you wouldn't leave.
I mean, you're not wrong.
Are they actually in control here?
It is a defensive maneuver, absolutely, but it is a calculated one. To understand why a drop in gross margin is sometimes a necessary evil, we have to look at the psychology of the modern shopper.
Okay, lay it on me.
So egg deflation simply means the commodity price of eggs dropped from last year's spikes. They bring in less revenue per carton, which squeezes the margin percentage.
That makes sense.
But the planned price investments you mentioned, that is where they intentionally take a financial hit. They are purposely shrinking their own profit on a box of cereal or a loaf of bread to keep the shelf price artificially low for the consumer.
Oh, I see. It's like the video game console model.
Yeah.
It's like Sony sells you the PlayStation at a loss or at a tiny margin because they know they will make all their real money selling you the video games and the online subscriptions for the next 5 years.
That is an excellent analogy. In grocery, the physical food is becoming the hardware. Taking a hit on the gross margin of groceries is a protective measure to maintain your loyalty.
Because if they raise the price of milk by 50 cents to protect their margin, you will just drive across the street.
Exactly. But if they keep you walking through those automatic sliding doors week after week, they retain the ability to monetize you through the real engines of their business.
So the food on the shelves is just the invitation to the ecosystem.
Beautifully put, yes.
Wait, though. If the gross margin on actual food is shrinking from 23% to 22.7%, how on earth did their earnings per share go up 6%?
That is the big question.
Where is the actual cash coming from? Because looking at these documents, the answer isn't in the physical aisles at all. It's in the digital infrastructure.
And this is the quiet transformation of the grocery industry. The financial tables show that their adjusted e-commerce sales surged 19% in the first quarter alone.
19% is massive.
It is. And the company attributes this almost entirely to the success of their under 1 hour delivery operations.
Which is wild to me, because paying gig workers to run around a store, bag your items, and drive them to your house in under an hour is notoriously expensive.
It's a logistical nightmare.
Yeah, historically, grocery delivery has been a massive money pit. But there is a milestone in this report that is huge. E-commerce, including media, reached profitability for the very first time.
They finally tipped the scales.
Yeah, and it's entirely tied to a category they label alternative profits. Their advertising division, Kroger Precision Marketing, grew its profit by more than 20%.
Wow.
And the report notes this was fueled by strong on-site traffic and increased advertiser commitments. Plus, they casually drop in their investment thesis that they're leveraging first-party data on 63 million households.
That is the gold mine right there.
So wait, a grocery store is making 20% more profit on digital ads?
I mean, are they a tech company now?
What's fascinating here is the sheer mechanics of how that first-party data pipeline works. Let's trace it. When you scan your loyalty card at the register, or when you log into the app to order that under 1 hour delivery, Kroger is logging every single variable.
Like what?
Well, they know you buy organic oat milk on Tuesdays, they know you just switched to a premium brand of dog food, and they know what zip code you live in.
Oh, that is incredibly specific.
Very. They possess a granular behavioral profile of 63 million households.
So they don't have to guess. Like when Purina wants to launch a new grain-free dog food, they don't buy a billboard on the highway and just hope dog owners drive past it.
No, not at all.
They go straight to Kroger Precision Marketing.
Exactly. Purina pays Kroger to place a targeted digital banner right inside the Kroger app, specifically shown to you because Kroger's data proves you own a dog and buy premium pet products.
That makes so much sense.
Yeah, you see the ad while you are already building your digital shopping cart. The conversion rate is massive. And here is the kicker.
What's that?
The profit margins on digital advertising and selling data access are astronomical.
Oh, right. Because there's barely any overhead.
Precisely. We're talking about tech-level margins, potentially 70 or 80%, compared to the low single-digit margins of selling a bunch of bananas.
That perfectly explains the gross margin drop from earlier.
Right.
They are completely fine taking a loss on the eggs and the bananas because the groceries just get you to open the app. The first-party data and the advertising revenue basically subsidize the physical operation.
It completely flips the traditional business model on its head. The store is rapidly becoming the physical manifestation of a massive, highly profitable data gathering network.
But I mean, the physical footprint is still a massive liability, right? The presentation notes they have roughly 2,700 brick-and-mortar stores.
That's a lot of real estate.
Yeah, tech and delivery are incredible growth engines, but you still have to pay rent, keep the lights on, and maintain the refrigeration in thousands of massive warehouses.
Very true.
How are they extracting more value from the people who still prefer to physically walk the aisles?
Inside the four walls of the store, they are pulling two very powerful levers: private label brands and the pharmacy.
Okay, let's talk about private labels.
Yeah, let's examine those. Kroger refers to them corporately as our brands. The data shows that these store brands outpaced national brands by 175 basis points this quarter.
And the report specifically calls out private selection innovation as the primary driver. And here's where it gets really interesting. Think back a decade or two.
Okay, yeah.
Buying the store brand used to carry a heavy generic penalty.
Oh, absolutely.
It was, a flimsy box with cheap printing, and you bought it knowing it probably wouldn't taste as good as the name brand. It was a total compromise.
Yeah, you were saving money but giving up quality.
Exactly. But look at your pantry today. A brand like Kroger's Private Selection comes in this thick, matte black packaging. It looks artisan.
Yeah, they are selling truffle, sea salt caramels, and imported cheeses.
Right. The report notes that their Our Brands division is now roughly a $39 billion business. $39 billion.
That is staggering.
That makes their in-house brand larger than many standalone global consumer packaged goods companies.
And the underlying mechanics of why they push these private labels are vital to understanding their profitability.
How so?
Well, when you buy a national brand of cereal, Kroger is just the middleman. The national manufacturer has already baked their own profit margin into the wholesale cost.
Sure, they need to make money too.
Right. But how does a private label work? Kroger goes directly to the manufacturing facilities, often the exact same factories making the national brands, by the way.
Seriously?
Oh, yeah. And they just white label the product. By cutting out the middleman, Kroger owns the entire supply chain. They capture the manufacturing margin and the retail markup.
Giving them total pricing power.
Exactly.
And reading the pharmacy section of the report, the exact same dynamic is playing out at the back of the store.
Oh, the pharmacy is fascinating.
The earnings release states that the pharmacy division delivered strong operating profit growth. But it wasn't because of, a spike in flu cases or more prescriptions being written.
No.
They explicitly state this profit growth was driven by an accelerating shift from branded to generic medications.
It is the exact same mechanism as the grocery aisle applied to healthcare.
Wow.
When a customer shifts from a highly expensive branded pharmaceutical to a generic equivalent, the overall revenue top line might drop, but the retailer's cut of the profit margin usually expands.
Because generic drugs are cheaper to source.
Right, and the pharmacy retains a larger slice of the reimbursement pie. If you zoom out and look at the entire ecosystem inside the store, Kroger is systematically engineering consumer behavior.
That is wild.
They are gently steering you toward the specific items, the private selection pasta, the generic blood pressure medication, where they completely control the underlying economics.
They own your entire wellness and daily routine. And they even catch you in the parking lot.
Oh, the gas stations.
Yeah, the report notes their fuel gallons sold outpaced the broader industry by over 400 basis points. So 4% growth over the industry average.
That's huge.
In the incredibly stagnant world of gasoline sales, stealing 4% market share is massive. And they attribute it directly to their loyalty rewards program.
It makes perfect sense.
You buy the high-margin private label groceries, you earn the fuel points, you feel compelled to buy their gas to use the points. It is a flawlessly closed loop.
It is a walled garden.
Yeah.
Every single component, the food, the pharmacy, the fuel, the mobile app, is designed to reinforce the others and make it economically irrational for you to shop anywhere else.
So we've mapped out how the machine prints the money. They have this intricate web of data monetization, high-margin private labels, and loyalty points.
Yeah.
But where's all this cash actually going?
Good question.
Because scanning these financial statements, running this walled garden, requires an unbelievable amount of capital.
It is incredibly capital intensive. If we turn to the operating, general, and administrative expenses, which they abbreviate as OG&A, the rate increased by 16 basis points compared to last year.
And the management commentary doesn't hide where that money is flowing, right?
No, they don't. It is directly attributed to planned investments in associate wages and hours to enhance the customer experience.
I mean, they employ over 400,000 people. So even a tiny incremental bump in hourly wages across that massive of a workforce translates into a gigantic line item on the balance sheet.
Absolute massive.
But wages are not the only thing draining the coffers here. If you dig deep into the adjustment appendices at the back of the report, you find millions of dollars in highly specific corporate maneuvers.
Yeah, those footnotes are telling.
There is an adjustment for merger-related costs and merger-related litigation. The footnotes explain these are third-party professional fees and credit facility fees tied directly to the terminated merger with Albertsons Companies. They list a rolling 4-quarter adjustment of $171 million just for merger-related litigation and settlement charges.
Wow.
And then there is another $62 million spent in Q1 on transformation costs, which they define as consulting fees for cost-saving initiatives.
The fallout from the Albertsons merger is really the defining context for their entire financial posture right now.
How so?
Well, that was meant to be a monumental, industry-altering acquisition. They spent years and millions of dollars on lawyers and consultants trying to push it through regulatory hurdles. Now that it is officially off the table, they have to pivot.
So what does this all mean for their future? We have CEO Greg Foran stating in the commentary that their clear focus is simply to become America's best grocer.
Ambitious.
But look at the financial reality. They're shelling out more in associate wages. They just abandoned a massive multi-billion-dollar merger, and yet they were reaffirming their 2026 financial guidance.
Right, they aren't backing down.
They still expect to generate between $2.7 and $2.9 billion in free cash flow this year.
And for anyone unfamiliar, free cash flow is essentially the pure cash left over after a company pays all its operating expenses and capital expenditures.
Right, it's the money they can actually use to reward shareholders or pay down debt.
Exactly.
And speaking of rewarding shareholders, they are executing a $2 billion share repurchase authorization by the end of 2026. Oh, and their net total debt to adjusted EBITDA ratio is sitting at 1.75.
Which is a very interesting number.
Right. So is this a company playing defense because their mega merger collapsed, or are they quietly playing offense?
If we connect this to the bigger picture, it is a masterclass in pivoting to internal strength.
Okay, tell me more.
It looks like stabilization, but it is highly offensive. Let's break down that debt metric you mentioned. EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Basically the raw cash engine of the business.
Exactly, before the accountants and the tax man take their slice. A debt-to-EBITDA ratio of 1.75 means their debt is less than double their annual raw earnings.
That sounds pretty low for a retail giant.
That is incredibly healthy. In fact, it is well below their target range of 2.30 to 2.50. This means they are sitting on a fortress of a balance sheet with a lot of dry powder.
Because they were probably hoarding cash, preparing to buy Albertsons.
Precisely. They were gearing up for a massive purchase.
Oh, that makes total sense.
Now that the deal is dead, they are deploying that resilient free cash flow to do two things simultaneously. First, they are investing heavily in their own infrastructure through those increased wages.
Right, the OG&A bump.
Yeah, because paying your people more reduces employee turnover, which directly improves the actual in-store customer experience. That's the becoming America's best grocer part.
And the second thing?
Second, they're unleashing value for their current shareholders.
The $2 billion stock buyback.
Yes. Think of share buybacks like slicing a pizza. If you buy back shares and retire them, you are reducing the total number of slices.
So inherently, every remaining slice becomes slightly larger and more valuable.
Exactly. They are committed to those buybacks and a growing dividend. They couldn't buy their biggest competitor, so they are essentially turning around and investing billions of dollars into themselves.
It is a fascinating corporate evolution. Just to quickly recap this journey for you listening, we started by looking at a simple grocery receipt and a slight drop in the profit margin on food.
Right.
But what we found is that running a supermarket in 2026 is an unbelievably complex ecosystem. You have to balance macroeconomic policy shifts from Washington against the commodity price of eggs.
Not an easy task.
No. And you have to master the punishing logistics of under 1 hour delivery. You have to operate a high-tech digital ad network fueled by the behavioral data of 63 million households.
Yeah.
You have to manufacture private label brands that look and taste better than national competitors, and you have to strategically manage a pharmacy's shift toward generic medications.
It's a lot of moving parts.
All of this while managing a workforce of 400,000 people and throwing off enough pure cash to buy back $2 billion of your own stock. It's a breathtakingly intricate machine.
It truly is. And as we wrap up our analysis, this raises a structural question, something for you to mull over the next time you are pushing a cart down the cereal aisle.
Ooh, leave us with something good.
We've unpacked the mechanisms today. We know that a grocery store's most explosive, high-margin, profitable future doesn't lie in selling food.
No, we proved that.
It lies in acting as a high-tech media network, a consumer data broker, and a healthcare provider. So what does that eventually mean for the physical aisles we walk through?
Right.
As the digital ad revenue and the data mining become astronomically lucrative, will the actual groceries, the milk, the bread, the produce, eventually become nothing more than a massive loss leader?
Wait, Could the physical food become just a heavily subsidized, cheap excuse to get you to log into their highly profitable digital ecosystem?
It's a very real possibility.
And completely shatters the way you look at a simple 50-cent discount on a carton of eggs. It's not a sale at all. It's an acquisition cost for your data.
Exactly.
Wow. Well, we want to thank you so much for joining us on this deep dive into the hidden machinery of the modern supermarket. Next time you grab your receipt, you'll know exactly what you are really paying for and, more importantly, how they are paying for you.